Welcome to Business Innovators Radio, featuring industry influencers and trendsetters sharing proven strategies to help you build a better life right now.
Hello and welcome to this episode of our program. This is Mike Saunders with Marketing Huddle, and today we have with us Paige Burkeholder, and she is with CapFlow Funding Group. Welcome to the program, Paige.
Good morning, Mike. Thank you for having me on today.
Hey, so give us a little bit of background. What is CapFlow Funding and what do you focus on? Obviously funding, but I'm sure there's some verticals and niches that you specialize in.
Sure, certainly. So CapFlow Funding Group is a specialty commercial finance company, and we focus on factoring and PO funding for small businesses. Our company was founded in 2009 by three managing partners, Andy Kuhn, Tim Laughlin, and Bill Gallagher, and our firm is based in Rutherford, New Jersey, but we have customers from coast to coast, so we have financing available for small businesses as long as they're domiciled in the U.S. My personal background, I've been a commercial lender for my entire life. I started in banking when I was 18, fresh out of high school, and worked my way up through the banking system. I worked for Norwest Bank, becoming then Wells Fargo. I took a little stopping out, but joined CapFlow Funding Group in 2009 in business development, in 2016 in business development, predominantly working in the Colorado Rocky Mountain region, but I also work with companies across the country, so I can work with anyone, anywhere.
Yeah, so you've got a background of traditional financing, and when you think about factoring and PO funding, that's a big difference. What did you find when you made the transition over from a traditional commercial lender? How did that transition work, and what type of unique and interesting opportunities did that offer to some of your contacts? Because I'm sure when you were talking to your group of contacts about traditional lending, that now this opened up a whole new opportunity for them.
It really does. And, coming from the bank side of things, the bank typically looks for a customer to be in business for 2 to 3 years, have very predictable cash flow and revenue. They want a strong balance sheet. They don't want to have operating losses or negative cash flow. And so the banks are really limited to the type of customers they work with. And going to factoring felt very free to me because instead of saying no that I can't help a company, I was able to say yes, and here's an alternative to get you from point A to point B. Small businesses definitely at some point want to be a bank customer because that is their lowest financing cost available to them. Mm-hmm. However, factoring, even though it does cost a higher percentage from an annual rate standpoint, it really opens up the door of opportunity to take advantage of sales that they would otherwise have to turn away. So the small businesses that I work with typically are trying to get to that commercial bank financing, but they need a vehicle to get them from where they are today to that lower cost financing down the road.
Yeah, so that's a really good point, and I want to hit that in just a second, but I want to first pause and let's clarify what is factoring. I'm vaguely familiar with it regarding probably accounts receivable and the things like that, and it's not really a true loan, but it is, and it's based on your receivables, and it's a percentage of that. But let's clarify for a business owner and even a new business owner that might not have those 2 or 3 years or not have 2 years of solid tax returns that they can go to that commercial lender. What actually is factoring? What does it look like?
Sure. So factoring is for small businesses that are doing business-to-business sales transactions where they're offering payment terms to their customer. And we are going to, instead of focusing, like a bank focuses on our client company, let's just say it's your company, Mike. You're making widgets. We'll call you Mike's company that makes widgets. And you're making widgets and you're selling those to other businesses. If you generate an invoice for $10,000, let's use a sample transaction. If you generate an invoice for $10,000 and you give your customer 30-day payment terms to pay you, because it has to go through their accounting system and so forth, you have expenses that you have to pay. You maybe have vendors that you need to pay or employees that have to be paid, but you're now waiting 30 days to get paid. What we can do is factor that invoice at 80% and give you 80% of that invoice amount today. So you're going to get $8,000 today that you can use for those other expenses. And then when your good customer pays, they're going to make payment directly to us, and we're going to pay ourselves back the $8,000 that we gave you initially, and that leaves $2,000 in the reserve. We're going to take our financing fee out of that reserve. Let's just say it's 2%, which would be $200. That leaves $1,800 coming back to you, and then that factored transaction closes out.
Okay.
So you can see that you can get that money faster today when you factor the invoice instead of waiting for your customer to pay on it.
Yeah, the thing that jumps out at me is that it's not a penalty, meaning I would have thought that you would have said, hey, if you want the money now, you get 80% and we get the rest. Yahoo, we're giving you a service, so we get the $2,000 or the 20%. But you hold that in reserve, and then your transaction fee is what you keep. And so, in reality, if 2% is the number you're using, and maybe there's a sliding scale and it goes from 2 to 3, but PayPal is 2.5% to 3% anyway. So that's a very fair transaction fee, and you're not having to wait the 30 days, and you're getting the money now, and then when the client pays in 30 days, the only thing you're hit with is the transaction fee, which you would have done if you ran it through a credit card.
A credit card anyway. It's very similar to a credit card transaction. Plus, we give you some additional services with that money. We do credit verification on your customers. So before you issue your customer payment terms of 30 days, we're going to make sure that that company has the credit worthiness to qualify for net 30 days on a $10,000 transaction.
And what if they don't?
Very significant. Well, if they don't, there's a couple things that we can do. One is we can go back and get bank and trade references and help verify that. And if we still can't get there, then it comes down to our client saying, boy, if CapFlow Funding Group isn't confident that this customer of mine can't qualify for, maybe it's a $250,000, maybe it's a $500,000 invoice.
Yeah.
It's a large dollar amount. Can't qualify for trade terms of that amount, and other companies aren't giving that company trade terms
maybe I don't
of that
want to
amount.
extend it to them
Maybe
either.
I don't want to, exactly, because what we don't want to have happen for both of our benefit, for us as a lender and for our client, we don't want to have it be an unsuccessful sales transaction.
Mm-hmm.
So we're going to help credit verify their customers. If you look at the large companies that are out there, Mike, they have whole departments that make credit decisions and giving terms to their customers. Most of my small business customers don't have the internal resources to do that. And so for the financing fee that they're paying, they're getting the additional service of our credit expertise in helping them make good underwriting decisions before they offer payment terms to their customer.
And I think that, number one, I like the business model of getting the money now and only having that transaction fee. That's really wonderful. The other thing that what you just described is nice is it makes that smaller business with 2, 4, 10 employees or whatever size the business is, it makes them look and feel that much better in the mind of their clients and customers, because it's almost like having your in-house financing department without having the expense of the employees and the training and all of that of having an in-house place. So yes, it's very clear that you're external and that you're not going to get around from that, but it really does make that small business look that much bigger. Is that something that you have found as well?
Yes, and sometimes third parties will want to pay. Sometimes our clients' customers, the third party, will want to pay a factor timely, because a lot of factors do report in on the trade. So when a company or a finance company or anyone pulls either a Dun & Bradstreet, Experian, Cortera, there's a multitude of different trade credit reporting agencies that companies report into and pull data from. And so when back to Mike's widget company, when your customer pays you, you're not reporting that into the trade. They know that you're a small business and that they don't have to necessarily worry about that. When they're reporting into a third party, a lot of times they're more motivated to make that prompt payment, because a lot of these third parties pay into the trade.
If the business had set up just the 30-day deal with that client as a transaction, potentially, maybe that customer might have just kind of, I'm going to let it go 45 days, and I'm going to let it go 60 days. And maybe that net 30-day turns into 60 or 90 days, and you're fighting and scratching and going back and forth, and you don't want to upset your customer, and you don't want to bully them, but you need your money. And in reality, this not only positions you well to that customer with bringing you guys in for such a low transaction fee, but it really helps them to toe the line, because somewhere in the communication, or just it's implied, that customer doesn't want to have a negative mark anywhere on their Dun & Bradstreet or TransUnion, because they know it's an actual transaction. I think that's a really huge piece.
Yeah. And the other piece that ties right along with that is the collection piece. So we also help them on the collection side. And when you say the word collection, people think, oh, bad debt. You're not a bad debt collection firm. But what we do is we want to help our customer collect the invoices when they're due from their customer, be it net 30, net 45, net 60 days. So what happens is when you, Mike, for your widget company, send that invoice to your customer for $10,000, and you issue payment terms of net 30, it's going to send a trigger after day 30 onto our account manager's system. And they're going to do a follow-up phone call or email, depending on how we've learned which is best to communicate with your specific customer, to follow up on that past due invoice. Because we want that invoice to pay as quickly as possible so that our portfolio turns, so that the cost is low for our customer, and to mitigate risk for both of us. Because the longer the invoice ages out, the greater risk is that there's something going on with that invoice. Be it, maybe the widgets that you were supposed to provide them were blue and they were supposed to be red. We want to make sure that we know that as soon as possible if there's any problems, either if we can help address it for them, maybe they don't have the invoice in their system, it's lost, and we can follow up and get that invoice on the system. Or maybe we have to go back to you, Mike, and say, you know what, the widgets were the wrong color and that's why they haven't paid. Can you call them and get this resolved?
Yeah. So it actually acts like a customer service function as well.
Exactly. And the collection piece is really key. And the thing that I really want to emphasize is that as a factoring company, we take a really white glove approach with dealing with our clients' customers, because we recognize the value that they have. Just like our clients are valuable to us, our clients' customers are their lifeblood. And so we take a very high-level service approach and treat our clients' customers as if they were our own clients, and taking and helping them follow up on the past due invoices and keeping lines of communication. Most of our small business customers, once they do the sale, they're on to the next thing. They're looking forward. They don't really want to look back and deal with the collection piece of it. In my years of lending, I've worked with so many small businesses. When you look at, they come in to me, even when I was a lender, they would come in to me and say, oh, you know what, my cash is tight. I've overdrawn my bank account. The teller line won't cash it because of the overdrafts. They want me to close the account. What do I do? And you pull the aging out and you see they just haven't followed up on the invoices. And that's
their
huge
AR is
piece.
just hefty, and you bring that to their attention, and they're going, we tried, and it just doesn't get done because of a variety of reasons. Maybe the owner is the one responsible and he's busy. Maybe they've got people pulled in many directions. Maybe they feel uncomfortable following up with their own customers because it's an uncomfortable conversation. So I think that's another huge aspect of it, of what you're providing to your customers. Hey, another thing you brought up that I want to go deeper on is you said that some of these small businesses need ultimately to get to the commercial lender for a lot of variety of benefits, whether it's sweep accounts or just a relationship, right? Well, what part of working with you helps the small business owner establish something, whether it's credit or a relationship, so that they can then take that to any commercial lender and say, now will you look at me because look at this?
Right. And, it's funny because it depends on the small business, and there's so many different philosophies. At CapFlow Funding Group, we have quite a few number of customers that could go get a traditional bank line of credit at, quote, a lower financing cost, but they like the service piece that they get from us and the flexibility of managing the relationship. So it really kind of depends on the core belief and the goal of the company. Some of our customers stay with us because they need and like the credit and collection support that they get. Some of our customers stay with us because we don't do a lot of balance sheet management. We don't have financial covenants that they have to perform to. We don't manage their balance sheet. We don't look at ratios and say, okay, where are you profitable this year? Why not? So we don't do a lot of that things. It's a very hands-off financing program because we're really focused on the transactions that we're financing and the ability of their customers to pay. But a lot of companies do want to get to bank financing, and so things that the owner has to consider when they're moving from factoring to bank financing is, are they keeping their capital in the company? Are they building equity in the business? Some companies choose not to. Business owners pull everything that they can out of the company. Some business owners reinvest a lot of money back into the company, and that will help position them to get to bank financing. So it really kind of comes down to the goals of the business owner and what they're trying to achieve.
Yep, makes sense. Okay, so we've been talking about factoring. How about PO funding? How does that work, and what's the difference?
Well, that's the more complicated piece of it. And in preparing for our discussion today, I was kind of noodling, like, how do I take an approach to this? Because it really depends on how each company works with both its customers and with its vendors. And so I think the easiest way to kind of go about this, Mike, is going back to your widget company and talking about the widgets that you are making and providing to your customer base. So let's go back to that $10,000 invoice, and let's just assume that you're going to make the product. To make the product, it's going to cost you $5,000. In PO funding, you're going to have a purchase order from your customer, from your buyer, for $10,000, and you're going to say, wow, I have this PO. How do I get the money to source this transaction? And
to
this
pay your vendors on that project.
Right. And so you need to pay a vendor $5,000. And this is kind of a small transaction dollar amount for PO. You typically want the transaction to be about, because really for $5,000, you could use a credit card to pay your vendor. So it doesn't really make sense for PO funding, but I'm using that dollar amount because it's easy and we can do our math in our heads. But you typically want a PO transaction to be a little bit larger in size, probably around $50,000 or more, to make financial sense. Otherwise, it's probably most cost-effective for you to use a credit card to pay your vendor for the $5,000. But anyway, we'll just stay with this dollar amount because we can do the math in our heads. So let's just assume it costs you $5,000 to source the product. And we work with customers that are either sourcing from vendors domestically in the United States, or maybe they're manufacturing it overseas. And depending on how we structure the PO funding depends on the complexity of the transaction. Sometimes maybe you're sourcing that widget that you're getting off the shelf from another manufacturer here in the United States that has it ready, complete, and it's already been made. I also work with companies that have a complex manufacturing process with an overseas manufacturer, perhaps in China or somewhere in Asia, where they have different terms with their vendor. They have to maybe give some money up front to start the production and then other monies to release the goods. So we work with them in a variety of different ways, either sending hard dollars via a wire transfer to the company here, either domestically or overseas, or maybe we need to use a letter of credit to provide some protection to both our client and us, as well as giving some benefit to the overseas manufacturer that's accepting the letter of credit. So there's a variety of different ways to structure it, but we'll just kind of talk about the mechanics of it to kind of give a flavor for it, and then just know that I work with the company based on how they work with their vendor and how they work with their customer. So we would send the $5,000 to the vendor on your behalf, and we're going to be looking at the margin in the transaction. So there's definitely sufficient margin in this transaction. It costs you $5,000. Your customer's going to pay you $10,000 for the complete product. We're going to look at the creditworthiness of your customer. Your customer is strong and creditworthy and can easily pay $10,000, say, over on a payment term of net 30. And then we're going to wire funds directly in this situation. We'll just pretend we're going to wire funds directly to your customer for $5,000. And then the clock starts ticking from the day we send funds out until you deliver the finished product to your customer and create an invoice. That's the purchase order funding piece of it. And so as you can think about different companies that you've talked to and work with, it really depends on how they work with their vendor and where their vendor is located, the payment terms of their vendor.
Why wouldn't the small business owner just create the invoice, net 30, like we talked about, and submit that as a factoring deal and get 80% and pay their vendor out of that?
Well, they could, but they have to have the product has to have been delivered to their customer. It has to be a valid invoice.
That's
the difference
requirement of the factory.
Right.
Got it. Okay.
Because they don't have a receivable yet because they haven't delivered anything to their customer.
Okay.
So we're actually financing the inventory piece of it while it's going to be their inventory.
Okay.
So we would send the $5,000 to the vendor, and now you've delivered your widget to your customer, and we're going to factor the invoice at 80% because you've generated an invoice for $10,000, and that generates $8,000 of factor proceeds. But we're going to use that $8,000 to first pay off the $5,000 that we've already sent to your vendor because you owe us $5,000. So we're going to pay that off, and that's going to leave $3,000 in what we call the reserve. And we're going to also take out the PO funding fee. So let's just say the PO funding fee for that time period was $250. That would leave $2,750 now in the reserve, and would send that money back to you. So you're going to get some of that margin at the time you invoice your customer.
You know, I just think this is such a unique
It's a little confusing. It's a little confusing. So they're going to get some of that. So they're going to get some of their $5,000 margin that they have in the transaction at the time they invoice the customer.
Yeah. Yeah, that's awesome.
So they can take that.
Here's what I would like to ask.
They can take those proceeds and use that to maybe fund the next order that they have to do or pay other expenses. And then when the invoice is paid by your customer, the $10,000 invoice comes in. Now you owe us that balance of $8,000. We're going to take out the factoring fee, send that remaining $1,800 back to you, and then that transaction closes out. Yeah. So it follows. So what's unique about this compared to, like, if you look out there, there's a lot of online lending platforms, and they can get they can get money $5,000 overnight, but they're paying the fee on that, and they're paying the principal back right away. Where this, when you pay this, it follows the cash flow of the transaction. So we're going to send the money to your vendor. When you invoice your customer, you're going to get some of the margin out at that point, and then when your customer pays on the transaction, you're going to get the remaining margin out, and then the transaction closes out, and the cash flow is going to follow the sales transaction as you build the product, deliver the product, and collect from your customer. And it makes it very smooth for you because the financing fees are tied to each of those milestones, and you're not repaying principal and interest on it before you've actually delivered or manufactured the product. Does that make sense?
Yeah, it does, and I just love the model because it opens up huge opportunities for small business owners before they're ready to go through the, let's face it, it's red tape, it's paperwork to go to a traditional commercial lender with, all the paperwork, and you might not be able to even meet those requirements. So this opens up doors today, right now. So what I would like to close with is, what's the best way for someone to learn more, connect with you, and see how a specific factoring or PO financing could benefit their business?
Sure. Well, I'm always open for a phone conversation, so you can always reach me on my cell, which is 720-371-6198. You can reach me via email at pburkeholder, and that's B as in boy, URKEHOLDER, at CapFlowFunding.com. And you can also visit our website at CapFlowFunding.com. And I am based here in Denver, but I can work with companies that are really based anywhere. And, the thing that I would like to, leave you with, Mike, is that at the end of the day, I try to find the right financing solution to fit the company. And you have a lot of companies out there that are seeking funds. And there's quite a different options available for them. I mean, they can turn the transaction away because they don't have the cash flow to take advantage of it. They can bring a private equity person in, which can offer some fantastic benefits, but it also is dilutive to their ownership. And so they have to weigh the pros and cons of that type of decision. But with factoring and PO funding is a way for them to take advantage of transactions that they would otherwise have to turn away and have a debt vehicle to do that, where they can maintain ownership and control of the business as well as take on good, solid sales transactions, and know that their lender is also walking with them side by side through those transactions to make sure that they're successful transactions for us as a lender, but also for our client. And I think at the end of the day, that's really how we differentiate ourselves. It's how we deliver cash, and cash as a commodity is how we deliver it to our clients that I think really makes a difference.
I love it. Well, Paige, thank you so much for your time here today on this interview. It was wonderful getting to know you and your product.
Well, thank you so much, and thanks so much for having me.
Thanks for listening to Business Innovators Radio. To hear all episodes featuring leading industry influencers and trendsetters, visit us online at businessinnovatorsradio.com today.